So what if you could get all of the money that you wanted at 5% and you knew you could safely invest it at 6%? How much money would you want to borrow? All of it, right? As much as you could get. Or alternatively, if a bank was willing to loan you $1 million that you could use to purchase a high cash value life insurance policy, a maximum overfunded high cash value life insurance policy, that would be pretty awesome, right? You would be paying simple interest on the loan, assuming it was an interest-only loan, and yet the cash value resulting from that purchase would be growing at a compounding rate. Well, this is called premium financing, and I'm going to explain in this video why banks are willing to do that and exactly just what premium financing is. So stick around after the intro video and we'll dive right into it. So I'm Tom Rutkowski, and I confess I'm a bit of a financial nerd. Things like interest rate arbitrage and compounding interest fascinate me. And premium financing is the Mac Daddy of interest rate arbitrage. Banks are willing to loan you money at simple interest that you can use to purchase a maximum overfunded life insurance policy. The goal of this channel is to demystify life insurance and give you the tools that you need to get the most efficiently designed maximum overfunded life insurance policy to do the double play, which is putting your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So today we're going to flip the double play on its head and take a look at premium financing, which is putting the arbitrage and the borrowing on the other side, on the input side. So you're actually borrowing money from the bank and using it to purchase life insurance policy. So let's start with the disclaimer. The primary reason for the purchasing life insurance should be the death benefit protection. Any other benefit is purely ancillary. Banks will happily loan you money so that you can put premium into a maximum overfunded life insurance policy. As you've noted from other videos of mine, in a maximum overfunded life insurance policy, the cash value of the policy is approximately 85% of the premium dollars that you're putting in. So nearly all of the bank's loan is collateralized by the cash value of the life insurance policy. And they get an assignment of collateral against the policy. So if they need to foreclose, they are already a part owner of the policy. The amount of money that you can put into a policy is only limited by your income and ability to make the interest payments on the loan, and by how much death benefit protection you and your family and your business need. But for an interest rate arbitrage nerd like myself, it's all about the simple versus the compounding interest. And if I can borrow $1 million at 5%, for example, I will happily pay that $50,000 of interest every year, knowing that the $850,000 of cash value is growing and earning a compounding rate of growth. So eventually it's going to get back to the point where it's equal to the $1 million. But it's also going to keep on growing, and with every passing year you're going to have an ever expanding gap between the amount of equity that you have, well, between the amount of cash value in the policy and the loan balance. So over time the cash value of the policy will greatly exceed the loan amount. Compounding interest is the most powerful force in the universe, and leave a note in the comments if you know who made that quote. So what are the pros and cons of premium financing? Well, certainly if you can put the bank's money to work to build your own retirement savings, that's a huge pro. But the con, of course, is that if you're borrowing very large sums of money, you have to have the income and the net worth to justify the amount of interest that you're going to be paying, as well as the amount of death benefit protection that you're going to be receiving. For example, if you're borrowing $1 million, that's at 5% interest, that's $50,000 a year that you're going to need to be able to pay. Historically, premium financing programs have only been made available to people who have a net worth of, say, $5 to $10 million or more. But more recently, insurance companies have started offering premium financing programs to what they call emerging affluent, which is a class of people whose incomes are rising and have the ability and need for more death benefit protection. So programs are now available for people with incomes as low as $100,000 a year and net worths of $250,000 a year or more. Although ideally, again, most lenders want to loan at least $1 million. That could be $100,000 a year for 10 years, or maybe a little bit less than that. But one way or the other, for this to be for you, you need to be able to swallow that chunk of $50,000 a year or more in interest. So I would say that this is geared towards people with about a $250,000 a year income and a net worth of, say, $500,000 to $1 million or more. So premium financing and the double play are advanced life insurance concepts, and it's important that you have a good grasp of the basics. So if you haven't already watched the videos for Life Insurance 101 and the other video for minimum and maximum overfunded life insurance policies, I'd suggest going back and finding those videos. I'll put a link in the description that you can use. I've also, on my webpage, I've got papers and blog posts and downloadable ebooks that you can grab those papers and take a look at them. But the 60-second overview is just that it's important to keep in mind that the premium in a life insurance policy is going into two different buckets. The cash value of a life insurance policy is essentially the policy owner saving up the death benefit for the insured over the insured's lifetime. So if you've got a $1 million death benefit policy, for example, then the premium is going to be such that, given some worst case interest rate assumption, also known as the guaranteed rate, that savings will grow and accumulate to the $1 million over the natural life expectancy of the insured. The insurance company is really only responsible for the gap between the death benefit and the amount of savings. So over time, the risk is transferred from the insurance company when you're very young and initially take out the policy back to the insured, who over time will save up their own death benefit. So it's important to keep in mind that a policy like I just described is a minimally funded life insurance policy. So I can't imagine any bank out there would want to loan money on a life insurance policy where most of the cash value or the premium is going towards the expenses and the cost of providing the death benefit protection. Banks like to loan money for maximum overfunded life insurance policies. And these are the complete polar opposite of minimum funded life insurance policies. So in a minimum funded life insurance policy, the goal is to get as much death benefit protection as you can get for the money that you're spending. The other polar opposite extreme is a maximum overfunded policy where you're trying to get as much cash value as you can for every dollar that you're spending. So banks want to loan money on maximum overfunded life insurance policies because most of the premium dollar is going towards the cash value and is there to serve as collateral for the loan that they're making. Alright, so let's take a look at the beauty of premium financing. The graph that I have on screen right now is comparing three things. The amount borrowed, that's in blue, the amount of the cash value in orange or yellow, whatever you want to call that color, and the amount that you're paying on the interest for the loan in green at the very bottom. So some things to take note of is the cash value in a maximum overfunded life insurance policy is about 85% of the premium dollars that you're putting into it. So you can see the relationship between the yellow line and the blue line at the beginning for the first 5 years. This particular example is only showing premium being paid into the policy for 5 years. So during those 5 years, you can see that the blue line and orange line are maintaining that 85% ratio, but by the end of the 5th year, they catch up. So the growth on the cash value and the compounding interest means that it's caught up to the loan balance. And beyond that point, you can really see the beauty of premium financing. So with every passing year, the gap between the cash value and the amount of the loan balance gets larger and larger and larger. You're paying interest on the loan to get those gains, but you can see that the little amount at the bottom in green is tiny compared to the amount of growth that you're getting year after year. So you can think of the gap between the cash value and the loan balance as your equity in the policy. Just like you have equity in a home, the value of the home is yours, and all you have to do is pay off the loan balance on it. That difference is yours. So now let's look at a less optimal design. So the beauty of premium financing is when you can get a loan with simple interest and yet put the capital to work in an asset that's growing at compounding interest. But some of the more recent programs for the emerging affluent require that the policy owner contribute some towards the premium in the policy. So some of the programs that are out there, like one of the most popular is called Kaizen, requires that the policy owner pay 50% of the premium for the first 5 years of the policy and then finance the entire premium for years 6 through 10. So on screen, I'm looking at an example of what something like that would look like. These are my numbers. They are based on standard insurance company costs, just not tied to any particular company or provider. What you can see here is that the interest is actually accruing on the loan balance. So instead of the loan balance remaining constant, as it was in the earlier example with simple interest, here the interest is actually being loaned to you, just like you would in a life insurance retirement plan. And then with each passing year, you're paying interest on the amount of money that you borrowed the previous year, the amount of money you borrowed this year, and the amount of interest that you're borrowing to pay the loan off, or to pay the loan interest. So in this type of situation, you don't have a comparison of simple interest to compounding interest. You're comparing two compounding balances. One is the loan balance, which is growing and compounding, and one is the cash value. And the only savior in this case is the fact that you've got 50% of the first 5 years premium in the policy. So whenever you have a compounding loan balance that's being collateralized by the cash value of the policy, you're dependent upon there being some interest rate arbitrage, or at least the interest rates being equal. And in premium financing, there's no guarantee that the rates are going to be equal. So one of the biggest cons of this type of approach is the fact that you are dependent upon the interest rate arbitrage being there. And it's the 50% of the premium that you're paying in those first 5 years that's really securing the bank's loan. So these types of approaches are a little bit more risky, but as you can see from the chart, they do work. Compounding interest is great when you're earning it, but not so much when you're paying it. So what are some of the risks in premium financing? Well, certainly the interest rate risk is the biggest thing. A lot of people worry about there being some negative interest rate arbitrage, but to a certain extent, any negative interest rate arbitrage is mitigated by the fact that we're still comparing simple interest to compounding interest. So over time, even if the rate that you're paying is greater than the rate that you're earning, compounding interest is a very powerful force, and it will eventually overcome. So again, the risk due to a negative interest rate arbitrage is mitigated by the fact that you're comparing simple interest to compounding interest. In the premium financing models where you're actually financing the interest on the loan, there you are much more dependent upon interest rate arbitrage, and a negative interest rate arbitrage could have detrimental effects. But even that is mitigated to a certain extent by the fact that the cash value of the life insurance policy is invested in the debt markets. So to a certain extent, loan rates and interest rates on bonds and mortgages are all tied to the return on the debt markets. So if interest rates happen to go up, it should also be the case that the returns on the cash value are also going up. So let's talk about using index universal life or whole life for premium financing. To be honest, it really doesn't matter. You can do this with either one. Again, the most important thing is that you're using a policy that's designed for maximum cash value. But given a choice between the two, my preference, of course, would be for an index universal life, because for two identically designed policies, the cash value of an index universal life should outperform the cash value of a whole life, because the cash value is capturing some of the equity premium. And in fact, most of the lenders that I work with prefer to loan for the policy owner to purchase an index universal life. And again, they do it from a risk mitigation perspective of their own, which is they want the cash value to grow and secure the loan that they're making. So the higher growth potential for an index universal life is better security for the lender. So if a bank is willing to trust their money going into an index universal life, I believe that an index universal life is certainly safe enough for you and I to put our money into. So a lot of the myths that you see out there from people that promote the infinite banking concept and others are simply unfounded. So go back and watch the videos for Life Insurance 101 and the minimum and maximum overfunded life insurance policies if you have any questions about how this works and why an index universal life can earn more and why it's just as safe as a whole life when you're talking about a maximum overfunded life insurance policy. And I'll put links in the description to those videos and to where you can find more information on my website. All right, so let's talk about exit strategies. If it were up to me, I would never close out the loan, because as you can see from the graph, the longer you hold the loan in place, the bigger the year-to-year change in the cash value. That exponential growth means with each passing year, you're adding more and more new equity to your policy. So I would refi until I die. But you also have the possibility of taking a withdrawal against your policy. And a lot of times life insurance illustrations will show a withdrawal occurring sometime around year 15. And at that time, the loan is closed out and all of the remaining cash value can stay in a new policy that can provide retirement income to the policy owner for the rest of their life. Alternatively, you could close out that loan by taking a policy loan and just simply transferring the balance of the premium finance loan to a policy loan. And at that point, you'd have a choice of paying simple interest on that loan, which I would recommend until you retire and you want to take retirement income from it, or just letting the interest be paid by further borrowing against the policy. So as I said earlier, you don't want to have a loan where you have compounding interest on it, but that's how life insurance retirement plans work. Once you retire and you no longer have the income to pay the interest on the loans, you take loans for retirement income, and then you borrow the money that it takes to pay the interest. So with each passing year, you pay interest on the money that you borrowed and the money that you paid in interest that you borrowed. So you have a compounding loan balance. So when you die, the death benefit pays off the loans and your beneficiaries get whatever's left of cash value. So it's important that you delay that as long as possible. So the longer you can continue to pay simple interest on it, the longer you build up cash value, and you build up cash value more rapidly, because with every passing year, again, you're building up more and more cash value, which generates more retirement income. But ultimately, to take income from the policy, you do have to start taking loans against it. So it's important to delay that as long as possible. All right, and wrapping up, this is probably the most boring retirement strategy that I know of, but it's also one of the most powerful. This is simply one of those things that you can set up, pay the interest on it every single year, and just know that in the background, the compounding interest is doing its work. And at some point in the future, 15, 20, 25 years out, you're going to have accumulated a tremendous amount of wealth, all paid for with the bank's money. So again, premium financing is the Mac Daddy of interest rate arbitrage strategies. The double play is a powerful strategy, but you're only putting your money to work. With premium financing, you're able to put the bank's money to work. And the amount that you put to work is limited only by how much you can afford to pay in interest and how much life insurance death benefit that you can qualify for. So I have links to all of the resources that I've mentioned in this video: the Life Insurance 101 ebook, the minimum and maximum overfunded life insurance policies blog post, as well as using whole life and universal life for the double play. You can also join the Facebook community for the double play and network with other like-minded individuals who are putting their money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So thanks for watching. Be sure to like and subscribe so that you're notified when new videos come out, and I'll see you next time.